taken up with a lot of community support by FASB. After a very thoughtful process, they came to the conclusion unanimously that they should give Bitcoin fair value accounting treatment rather than indefinite intangible accounting treatment. The latest communication on that indicated that they'll make this mandatory for all public reporting companies as of December 15th of next year. So as we go into fiscal years that end after December 15th of 2024, this will be common practice. And between the beginning of 2024 and the end, it'll be optional, I think, for companies to decide whether they wish to adopt it. And the significance of fair value accounting is that you account for Bitcoin similar to the way you would account for a portfolio of securities on your balance sheet. It kind of works like this. If I buy $1 billion of Bitcoin and it trades down 50%, then in that period, at the end of the period, you'll value it at what, in this case, it would be valued at $500 million. You'd be holding $500 million on your balance sheet, and you would have a $500 million loss. But you would report the investment loss separately from the operating gain or operating loss of the portfolio. So now you would see there's an investment with an investment loss, and the fair value at the end of the reporting period is this much, $500 million. Now, if you go a year further and you regain that loss and you double it, you would now be showing $1.5 billion worth of investment gains. You would have $2 billion on your balance sheet. And the operating losses or gains of the core business would continue, unobstructed or unmodified. So now you have two parts of the business. You have the balance sheet part of the business where you have investment losses and investment gains. And you have the P&L, or the operating side of the business where you have operating losses and operating gains. This is really critical because if you have a healthy business, let's say Facebook or Apple, and you have a lot of cash flow, you're never going to want to present the business as though it had no cash flow or it had no operating profit and it was losing money by virtue of owning a volatile treasury asset. So the volatility of Bitcoin combined with indefinite and intangible treatment makes the holding of it toxic to a conventional company. A conventional CEO, a conventional CFO would never want to hold anything more than a trace amount. This is one of the reasons why many people considered it and didn't take it on their balance sheet, why other companies that hold it don't want to hold more than a small amount, 5%, 2 or 3% of the balance sheet. So the transition to fair value accounting means that now they don't have to worry that the volatility of the asset will interfere with the transparency of their operations. And that's a big plus. And the second plus, of course, is if I told you you could invest money in something, but you could never recognize the gains from the investment, that would be a big letdown, I guess, a big negative. If I'm going to invest $1 billion and make $10 million, but no one knows, then I guess I would rather invest $1 billion in something that I'd be able to compensate for or recognize for, rewarded for. So with fair value accounting, not only do you not interfere with the transparency of the operating business, but you also are able to recognize the investment gains over time, both in your P&L. You can show, if you're holding $1 billion of Bitcoin and it trades up 20% a year, you'll be showing $200 million a year of investment gains, right? So that's significant. That actually will impact your EPS, right? So it's going to be accretive to your earnings per share, and it's going to be accretive to your earnings in general. So that's a plus. It's also going to be accretive to your balance sheet. Now you'll show that your balance sheet grew by $200 million in that period. So that's a big plus. And then there are some intangibles here. Well, not intangibles. There are secondary benefits. If you have fair value accounting, and this year you have $10 billion in Bitcoin, but last year you had $5 billion, then when an objective observer or an investor looks at your P&Ls and your balance sheets over 3 years, they'll see you went from 2 billion to 5 billion to 10 billion. And that makes sense, that's logical, right? That tells a story in a matter of seconds. But under indefinite intangible treatment, the balance sheet would show 2 billion going to 1 billion going to 800 billion over the 3 years. So the story is actually the opposite of what happened. It looks like you have a lot less money. It looks like it's not, the strategy's failing, not working. And you can't compare previous periods to current period. So it's impossible to compare the strength of one balance sheet of a company over time with indefinite intangible. With fair value, you can. And then, of course, if you're comparing two companies, they both hold Bitcoin. One company has $10 billion of Bitcoin. The other company has $5 billion of Bitcoin. Under indefinite intangible, it could look like the company with less Bitcoin has more, and the company with more Bitcoin has less. See? The company that has the 10 billion could look like it has 1 billion, and the company that has the 2 billion could look like it has 2 billion. And so you can't compare one security to another security, or one investment security to another investment because you don't have transparency to the fair value at the end of the period question. So you can see as an investor, under fair value accounting, you can get a snapshot of performance across various investment ideas and performance across time periods and the real-time strength of the P&L and the performance of various operating businesses versus each other. And you can figure it out in a matter of seconds. And under indefinite intangible accounting treatment, you would take hours and hours to extract the same insight. So something would be 100 times or 1,000 times harder. And of course, if it's 1,000 times harder for me to understand what you're saying, I would just tend to tune out, right? I mean, professional investors have to compare 10,000 different ideas every minute of the day. They don't have time to spend a week comparing one idea to the other 10,000 ideas, right? It's the odd man out or the oddball, so you would just ignore it. So the significance of fair value accounting for Bitcoin is it makes the asset non-toxic for an operating company to hold that uses GAAP accounting. It also makes it transparent, the performance of Bitcoin-backed companies to be transparent, and so that's a positive feedback loop, right? When Bitcoin companies are performing well, it'll be obvious to Wall Street, and they'll want to finance more of them, right? So that's a secondary benefit. And the third is, because Bitcoin is a commodity, it's a financial commodity, it can be held on the balance sheet of an operating company where right now only treasury assets or sovereign debt type assets can be held on that balance sheet as a treasury strategy. So before Bitcoin, there really wasn't any good fungible commodity that I might hold on the balance sheet. My choice was securities or property, but I can't really hold property on my balance sheet if I'm a corporation, investors in SEC 40 companies. And the result is they're good for what they do, which is they're there to acquire, to serve as trustees and to acquire a set of assets for investors and be trustworthy custodians. But they're not very good at, you would never read your gold ETF as just bought a chain of restaurants or a chain of trucking companies. They don't do acquisitions. They don't do volatility, they don't do leverage. That's not what you want from your SEC 40 company. You want them to be very, very simple vehicles. And so for that reason, Microsoft and Facebook and Apple, they're not simple. They're here to do more complicated things, and they don't want to be deemed as an SEC 40 reporting entity, which means that as a practical matter, when they acquire cash flows, they're either going to buy currency or they're going to buy sovereign debt with it.
The Bitcoin Layer is proud to be sponsored by River. Go check them out today at river.com/TBL. Why do we love River? River is a Bitcoin-only exchange. They offer Lightning Network deposits and withdrawals. And most importantly, guys, they do not outsource custody of their Bitcoin and customers' Bitcoin to a third-party custodian. River has its own multi-sig custody solution. That means that it is not using some other company to store Bitcoin that is purchased for operating companies. Where can you go check them out? Their platform. So make sure you go check them out, river.com/TBL, and learn about River today. So when we think about the benefits from buying Bitcoin versus sovereign debt for operating companies, where can we start? Obviously, we can start with the risks of sovereign debt, but what else can we do to compare Bitcoin to sovereign debt with regard to operating companies and the use for that working capital, as you suggest, holding on to that cash is actually dilutive to shareholders?
So, yeah, you're right to focus on operating companies, right? There are a lot of people that have to decide whether to invest in Bitcoin or invest in sovereign debt, right? You've got endowments, you've got retail investors, you've got nation states, you've got institutional investors, and you've got operating companies. So we'll leave aside those other investors, we'll focus on operating companies. Operating companies, they have a couple of challenges. One is they have this 40% cap from the regulators. They're not allowed to buy a bunch of liquid securities. So they are allowed to acquire a lot of property. It's okay if you've got $1 billion in working capital, you can buy natural gas with it, or oil, or timber, lumber, soybeans. You can buy land, buildings. You can buy Bitcoin, or you can buy sovereign debt. Now, if you think about your treasury strategy, the treasury strategy of an operating company is we want something which is liquid and fungible and low risk. So traditionally, the most liquid, fungible, low risk financial asset is just the dollar, the local currency, maybe the euro, maybe the dollar, and so that's the obvious thing to do. I collected $100 million this month. I put it in the bank. Now, the problem with that is that the dollar doesn't generate a yield, and the dollar is a depreciating, debasing financial asset. So in a world where the dollar gets inflated 7% a year, if the money supply of U.S. currency increases 7% a year, and it has over the past 100 years, then $1 billion in cash is going to cost you $70 million a year in purchasing power. And of course, at 7% a year, over the course of 10 years, you'll cut your asset value in half. So it doesn't take a rocket scientist to figure out that a treasury strategy based just on currency isn't awesome. It's dilutive. The question here is, what's the next best thing? Well, the next best thing is sovereign debt. Sovereign debt is debt issued by a government. So you've got the most creditworthy counterparty, maybe the United States government. You don't really think they're going to default. And that's the advantage of sovereign debt. You might take on duration risk. If you buy long-term bonds when the interest rates are low and interest rates go up, then the bond will trade down and you could get wiped out that way. That happened to a bunch of banks about a year ago. Silicon Valley Bank and the like, they bought long-dated credit instruments and interest rates jumped from 0 to 500 basis points. And then the debt traded down 10% or 15% or 20%. And when that happens, you're insolvent, technically. So there is duration risk, but if you buy 3-month T-bills yielding more than 500 basis points, then now you've got some yield. You're not concerned about the credit default risk. You're not really concerned about the duration risk. And so what's the benefit? Well, 500 basis points is better than 0 basis points. And on the other hand, what's the problem? The problem is it's taxable. So it's 500 basis points taxable. It might only be 300 or 350 basis points after tax. So let's say you get to 350 basis points after tax or 3.5% interest. Now the question is, what's the real cost of capital? Well, the risk-free cost of capital for an operating company is set by the central bank that controls the currency that it does business in. So if all of your revenues and all of your cash flows are in the dollar, and if the supply of dollars increases by 7% a year, the risk-free interest rate or the risk-free cost of capital, the hurdle you've got to get to is 7%. And in this particular case, generating 3.5% interest against a 7% cost of capital means that you're burning 350 basis points every year. So that's not, it's not ideal, it's dilutive. And of course, companies are actually expected to generate not the risk-free cost of capital, they're expected to generate the cost of capital plus a risk premium. So if you're investing in Apple or in any company, Apple's not the best example because Apple is a digital monopoly and everybody knows Apple's going to dominate. But if you just took the middle company in the S&P index, number 250, and you would say, is there risk to that business? Sure, there's risk to that business, right? The Chinese might embargo the product. There might be tariff. There might be strikes. Right now, there are strikes with all the auto companies. There might be an embargo or a trade war between one region and another. It might be the European Union might designate you as a monopoly and put some fine on you or put some tax on you. So no matter what company, there's risk, competitive risk, embargo risk, war risk, tax risk, labor risk, etc. And for that reason, normally what you want is not 7%, the risk-free rate. You want an extra 4, 5, 6%. So, I mean, probably the right number is 14% is where you have to get to, but just generally everybody would say at least a 4 to 5% risk premium, so 12%. So the investors are looking for you to generate 12% return. You're getting 0% on your cash. You're getting 3.5% after tax on your sovereign debt. So what really happens with operating companies? Well, generally, most CFOs and CEOs that are sophisticated, they look at this and they realize that if I generate $100 billion of cash flow, and if I hold it in my treasury in sovereign debt, then I'm generating 3.5% after-tax yield instead of 12% after-tax yield. And that means that I am short 8.5%. And so I'm underperforming by, call it $8.5 billion a year. This is a problem for the shareholders. The shareholders are going to say, if Apple Computer accumulated $100 billion of sovereign debt yielding 500 basis points, the shareholders would start to say, well, this is dilutive, and you're actually missing out on an opportunity. You're not generating 12 to 14% returns. You're generating 3 to 4% returns for me. Give me the money back. I can do better. Okay, and so The result is an operating company strategy or treasury strategy is normally this. You either dividend out the cash flow, you pay a dividend, Apple pays a dividend, or you buy your stock back, you do a buyback, Apple does a buyback, or you do acquisitions and you take the cash and you acquire another company. Disney, for example, is famous for doing acquisitions. They bought Pixar, they bought Marvel, they bought Lucasfilms, right? And that was considered to be reasonable, even though they paid a lot for those assets. Facebook did some acquisitions. Oracle does lots of acquisitions. They've been doing acquisitions for 20 years. So conventional wisdom for operating companies is take your cash and do acquisitions, issue dividends, or do stock share buybacks. And of the three, the preference is generally either share buybacks, invest in yourself, or acquisitions. Go buy some other asset which is undervalued. Microsoft right now is doing this big Activision acquisition, a very big one. And why do they do those things? It's because the monetary policy of the central bank forces them to get rid of their cash. If the monetary inflation rate was zero, if there was no monetary inflation rate in the euro or the dollar, then you could simply put your money into cash and it would get more valuable over time. You could probably sweep your money into debt instruments and it would get more valuable over time. And so this hurdle rate wouldn't be 7%, the hurdle rate would be 0%. And it would change your view of saving toward versus investing. But we live in a world where there's always systemic and endemic inflation. In the weaker nations, it'll be 14% monetary inflation, and in the stronger currencies, it'll be 7%. And when you tack on top of that the risk premium, that means that a stock value, an equity share, cannot hold its value unless you can grow the cash flows per share faster than that inflation rate, right? If you want to avoid losing value, you better grow EPS, earnings per share, faster than 7%. And if you want to actually accrete value, you better grow it double that or triple that. And how many companies can do that organically? Somewhere in the neighborhood of 1 or 2%, right? So a very small number. Out of the S&P 500, you'll only find a handful that can grow faster than that inflation rate organically. debt from the United States, you still have sanctioned counterparty risk. If you're on the wrong side of the nation in a war, then you're going to find yourself sanctioned, and those instruments are going to be canceled. So they are securities. They're securities issued by a government, right? A nation state. They're senior to, of course, a whole class of other credit securities, like the municipal bonds that are issued by cities like New York, or states, or of course, corporate bonds and other kinds of bonds. Bitcoin is advantaged to those sovereign securities in a variety of ways. One is there's no counterparty, so you don't have a council that sets monetary policy. That's a big advantage. The second is there's no nation state behind it, so that's a big advantage. The third is it is a asset you can self-custody. It really isn't.